Google stock hit an all-time high in 2025. That officially makes it a 100x returner for investors who got in at the IPO. But is Google a good investment moving forward? Brian Stoffel and I hosted a live webinar with our newsletter readers. And in that webinar, we showed them the step-by-step process that we use to analyze Google stock from scratch using AI to help us. In this video replay, we'll show you the complete process of how we research a stock from scratch using AI. This includes how Google makes money, its moat and moat direction, key financial numbers, risks, valuation, and a lot more. By the end of this video, you'll learn the exact process that we use to research a stock from scratch using AI, so you can do it on any company of your choosing. Let's dive in.
Well, hello everybody. Okay, well, thank you guys for joining us today. We hope that you're going to enjoy this this session. We will kick it off. So we are going to be researching. Good. I'm sharing the right thing. Cool.
Yep.
We're going to be researching Google's stock from scratch. Google's had a heck of a resurgence in the last just like week. Or so. It was really down in the doldrums. So we're huge fans. If you followed us for any of this period of time, I will be able to. What will you be able to do at the end of this hour or so together? And it is basically to know how to research a stock from scratch. Quick housekeeping. If you guys could use that Q&A button down below. They should have the Q&A button, right?
Yeah, that's what I'm going to be monitoring.
Yep. So if you have questions, please put them in there. That way we can make sure we answer all the questions that we have. So use that button down there if you have a question for us, and we will be taking questions kind of throughout this series. So,
and
all right,
Brian, real quick, just also so people know, this will be recorded and
Yes.
sent to folks afterwards.
This will be recorded, and I will be sending it to everybody after this is done. Everyone that RSVP'd, which you guys clearly did, you will be getting a copy of it. So which stock are we going to be doing? Well, we're trying something new. So last week in our newsletter, which everybody here gets, we included a poll saying, hey, which stock do you want us to look at? And we put some stocks in there. And we asked people to vote. Google came away with a 33% share. Then NVIDIA was number 2. SoundHound was number 3. So if you have stocks that you want us to put on this list, reply to the newsletter and let us know. Put it in the chat here. We will be keeping track of stocks that interest people and they want us to research live. So we plan on doing many more of these in the future. So please do let us know that. Now, how are we going to be researching this stock? We're going to be using a tool that Brian Stoffel and I built that we call a Stock Simplifier. So here is the one-page cheat sheet that we include as part of Stock Simplifier, and it's basically everything we think you need to look at a minimum before you can know if the stock is investable or not. Now, if you're unfamiliar with Stock Simplifier, just to let you know, there is a full course that goes along with it. There's a spreadsheet tool that's like a checklist. We're also going to be using that. And this is brand new. We just released these brand new AI prompts that are part of Stock Simplifier. And we're going to be using the checklist and the AI prompts to do this analysis. So as part of this session, you're going to basically see us do the entire Stock Simplifier process. Now, Stoffel, thing one, very first question we ask is the business growth cycle analysis. What the heck is this?
Yeah, so this is foundational to everything that we do, because we think one of the big mistakes that all investors, but beginning investors especially, make is that they treat every stock as if it's the same, which really doesn't make any sense. If we were evaluating, say, 2 athletes and one was a first grader and the other was a professional, it wouldn't make sense to do them on the same metrics. Well, the same is true for publicly traded companies. A company that's just starting up is asking itself a key question like, can we actually come up with a product or a service that has a market fit? Once it does, you can move on to hypergrowth, self-funding, and so on. The 2 things to really know about this chart right here is that top line, the blue one, that represents revenue growing over time. And so you can see that on a percentage basis, it grows quite fast until it starts to slow in stage 4 and taper off in stage 5. The lower line, which changes colors, it starts off as red because those are either operating or net profits. Those are negative and getting worse in the startup phase. They peak and then start to get better throughout stages 2 and 3. And then you cross the Rubicon to becoming self-funding, to having profits after that. And so determining which stage of the business growth cycle a company is in affects everything else we're going to be doing. So that is really, really important.
Yep. We think this is absolutely the very first analysis you should do on any company is which phase it's in. So let's start with a poll. Stoffel, which of the 6 phases do you think that Google is in? And I'm going to put that sheet back up just so people can vote. Which of these 6 phases do you currently think Google is in?
Yep. And you can also just ask yourself, what question do you think management is probably asking themselves? And you can look at the bottom and see that there.
Yep. So we'll wait for about 30 seconds or so on this. We want to make sure that the voting is working. It is working. More than 60% of people have voted already. Very cool. Stoffel, can you share?
You bet I can. So Brian, it looks like we've kind of got 2 front runners. Operating leverage phase 4 got 51% of the votes, and right behind it was capital return phase 5 with 41% of the votes.
All right, so let's walk you through how to do this. So this is our Stock Simplifier tool. The first thing I'm going to do is I'm going to click this, and I'm going to open up a fresh copy of our checklist that you do. I'm going to click this button right here to make a copy, and that's going to pull up the checklist. The checklist that you can use. Now we built this so that we teach you how to do all this manually. So here's the tool that we built that kind of walks you through how to do this. However, this brand new thing right here, you click AI prompts, and this is going to pull up our database, our Notion database of AI prompts. So here are all the prompts that are included in Stock Simplifier, and we're going to use AI.
Brian, before we put that in, do you just want to go over just the next 3 slides so we can just review what the AI is going to look at real quick?
Sure. Yeah, sure. That's okay. Sure, let's do that. So the AI, good point. The AI is going to analyze the company's revenue. It's going to analyze its operating profit, and it's going to analyze its dividend or buyback history. Is the company returning capital to shareholders? Now, that matches up with our 6 stages here, and it's actually going to use the income statement to kind of figure that out. So these are the 3 numbers it's going to look at on the income statement to analyze this. Now, as I just said, the tool that we have, the checklist, allows you to do this manually. So you can use drop-down boxes, and you can kind of go through this and analyze it manually, but we're trying something new here. We built these prompts, and I'm going to open up this prompt. So here's the prompt. This is version 18.7 of this prompt. This prompt has taken us months to get right. Now, I am going to use ChatGPT for this because it's the most popular. So let's paste this in here and see how this goes.
So Brian, just to clarify, what you did was you just copied everything that was in the prompt and just pasted that in ChatGPT.
Here's the prompt. Yep. So we have a Google link if you prefer Google, but here's the full prompt. All I do is click copy to clipboard. I go over to ChatGPT. I pasted it in there. And by design, it then says, okay, I know what to do. What company do you want me to analyze? I'm going to zoom in a little. Is that good? Can you see that?
Yep.
Okay. So I'm going to say Alphabet, and then I'm going to do Google. It's best if you can do the name and the ticker symbol. So let's put this in and see what ChatGPT says. Fingers crossed it works properly. Okay, so we have an answer here. So ChatGPT says the current stage is phase 5. Phase 5. And it has a confidence interval here. So it's highly confident in this answer. We've designed the prompt so then it says, okay, give me the evidence. Give me the supporting evidence. So this says operating income is positive and increasing. And it's got the source right there, Q2 of 2025, the most recent 10Q. Then we have revenue growth of 14%, growing that year over year. And then we have this, capital returns. Yes, it has an increasing dividend, and it bought back stock in Q2 of 2025. Now, as part of this, it also says, because it's in stage 5, here are the valuation methods that you should use to analyze the valuation, which we're going to do at the end. Here is why this methodology fits, and as well as avoid these valuation metrics. So it's making all this analysis based on the phase that it is in. And then here is some more details. Brian, one other thing I want to show you. So at the bottom, it has direct sources. We have programmed this prompt to only include direct sources, SEC filings, and this didn't work. This is supposed to be a link that you click and it takes you to this visual, just as a backup.
Hey, real good question about that then, Brian, because Brian Grover is someone who subscribed to Stock Simplifier. He says, do I have access to this through my account?
You certainly do. Yep. Everyone that has Stock Simplifier, we put it in there. So yep. It's right here. All the prompts are right here. There's also a link down there, but everyone that is subscribed to Stock Simplifier has access to that. So, okay, there is our AI demo, and Brian, AI says capital return. What do you think?
Yeah, real quick, one thing, because I know that a lot of people voted for stage 4, and Brian, when you and I were first talking about this, I was split between stage 4 and stage 5. I believe that this provided evidence that it is in stage 4, and here's the key. One, we know it's returning to shareholders, right? So capital return, they're paying a dividend. But I actually think even more important, because I think there are stage 4 companies that do start paying a dividend, right? Mercado Libre, believe it or not, was doing that. But the key to me is revenue's growing at 14%, and so is operating profit. They're growing at roughly the same pace. If revenue was growing 14% and operating profit was growing 40%, then I think there could be an argument made for stage 4, but that's not the case. So I just wanted to point that out.
Yep, that's a great point. I don't think you're going to go wrong necessarily getting 4 versus 5. I think your analysis would be wrong if you said 1, 2, 3, or 6.
Yes,
so 4
I
and
agree.
5 are close enough to each other that you won't get that wrong of an answer. But if you said which one is it in, I would 100% agree with ChatGPT here. This is in the capital return phase. Very cool. Okay, so tuck that away in your brain. Stage 5. Actually, in Stock Simplifier, let's go ahead and choose stage 5, because that does change the rest of the analysis. Okay, step 2, the business. So in Stock Simplifier, we're going to be looking at this line here. This is when we're going to analyze the business. We need to know these questions. How does the company make money? What are its key products and services? Who are its customers? Where does it operate? Foundational questions. And then, how often do customers buy? Can it raise prices? And what happens in a recession? So these are all foundational questions that you need to know about any business before you analyze them.
Now, Brian, usually we encourage people to go to the 10K and actually read the entire business description, which I think we would both argue is still the best way to answer this question. However, I feel like we would lose a lot of people if we started doing that live on this webinar.
Yeah, so that is something we absolutely encourage you to know how to do. But again, we built this prompt. So here's the prompt. Let's go to ChatGPT and let's put this prompt in here. So here's our big prompt. And if it's doing it right, it should say, now I'm going to skip the think longer, go faster.
Hey, Brian, I got a question here. Someone asked, what is a 10K? We just said they should read the 10K.
10K is an annual report. It's the filing that all publicly traded companies in the United States have to file with the SEC. It's a fairly robust document, but it explains everything that's on that chart, as well as risks, financial statements, management. It's a huge, amazing document. Okay, here we go. So what company would you like me to analyze? Alphabet/Google. All right, let's see. Let's see how this goes. Okay, I retrieved Alphabet's most recent 10K and TQ. Here's the analysis based on 2024 10K. So this is the most recent annual report, and it's also using the most recent 10Q quarterly report. All right, business overview. What does it do? Alphabet is the parent company of Google. Wide range of services and products, most notably search, advertising, YouTube, Android, Chrome, Google Cloud, hardware, subscription, and experimental projects because of other bets, such as autonomous driving and stuff. Great. How does it make money? Here are the major revenue sources and segments, from most to least significant based on 2024.
Oh, I like that.
Google services, $304 billion, 87% of total revenue. This
So
includes advertising, search,
advertising.
YouTube's, Google network, subscriptions, apps, hardware. So it's not breaking out YouTube. I think Google does that. It's kind of combining it together.
But YouTube is, again, it's still advertising. Like
It's
it's
still
still
advertising.
ads.
Yep. So number 2, Google Cloud, 43 billion, 12 to 13% of revenue, which includes enterprise, infrastructure, platform services, and collaboration. Finally, we have other bets, which is 0.5% or less, experimental, emerging businesses that are unprofitable. So far, this looks pretty accurate. And there's the links. There is the direct links to the sources.
That's awesome.
That is very critical. Very
Yeah.
critical with AI. You have to say, show me the original source, because otherwise it hallucinates like crazy. It took us a long time to make sure that was doing it. Okay, who are the customers? Advertisers, businesses who pay for search in Google, consumers and users of its free and subscription products like us, enterprises and organizations, developers, partners and devices, and for other bets, niche and emerging companies and markets.
Let me just pause right there and say, when I look at that, I'm reminding myself that even though it's got all those different lines and I'm like, oh, lots of, variety in who their customers are, the bottom line is advertisers is still the vast majority of that. So, it spits out all of that, but you got to layer in your own understanding on top of it.
For sure. I zoomed in. I saw somebody's comment about
Yep.
zooming in. Hopefully that makes it look good. Okay, we just saw the customers. Where does it operate? United States is half of revenue, 49%. Now that comes from TradingView. Okay, so that just note that. It looks like it's pulling from the 10K, but ChatGPT is pulling from TradingView. Europe, Middle East, Africa, 29%. Asia Pacific and other. So cool to see that. Roughly half is US, half is elsewhere. All right, now business qualities. How often do customers buy? For advertisers, purchases tend to be frequent and recurring depending on campaign schedules. Subscription products are recurring, definitely. Cloud customers have subscription or usage-based contracts, definitely. Other bets is one-timey or long-term, and retention is high, but the rate of renewals is not disclosed. Strong details to me.
Again, just because I know the business and I know how to weigh each one of those, that first bullet point is the one that matters for me, although the cloud customers have become more and more important with every passing quarter.
Question 2, can it raise prices? Yes, there is some capacity. Evidence includes advertising cost per click. The 10K warrants changes in the geographic mix might cause that to happen. This implies pricing pressure is a known risk.
That's really important.
Margins have expanded, so operating margin rose from 32% from 27%, suggests some leverage and ability to maintain or raise prices. And then cloud segment growth is strong, rising demand, but it's also capital and infrastructure costs are high. All right, final question. What happens in a recession? Advertising revenue tends to be cyclical, for sure. Advertisers' budgets often shrink, especially on brand advertising. Alphabet acknowledges that. Strength in the US helps, but international exposure means foreign currencies and macro shocks matter. Some resilience from subscription and cloud infrastructure, which may have more stable demand, but we already know that's only 10% of revenue, 15% of revenue. And then expense structure has very high fixed costs with their sources. Okay, the prompt did its job. I would say that was a successful prompt run.
Yeah, so the one thing I would just add to this is when it talks about can the company raise its prices, that's a real that requires a level of thinking that probably goes a little bit beyond what the AI can do. Because yes, of course, they have a history of being able to raise prices, and that's great. I still am one that believes that the market is largely going to determine how much they pay for an ad, and it is, as it says, it is very cyclical. So I think that that's important to point out.
Yeah, but if I was to answer this, I would say, okay, I would say that we now know more about
Yes.
Google's business than
No
most
doubt.
retail investors.
No doubt.
And we're thinking it's mostly a recurring business. Can the company increase prices? Maybe, maybe not. And then what happens in a recession, I would say it's normal, normal demand. It's not ridiculously cyclical. I would say it's normal cyclical. So, all right, poll time. What do you guys think? Is this an attractive business? Red, no. Yellow, yeah. Green, absolutely. What do you guys think? Is this an attractive business?
While people are voting, Brian, what do you think?
Well, it's like my number 4 holding personally. So I would hope it's a pretty attractive business. This is true story. This is the stock that I have held the longest.
Since?
I first bought shares of Google in March or February. I bought it and it still went down. So I'm going to say January of 2009. So
Oh,
I've
well
held
done.
Google stock for, am I 16 years now?
Well done.
16?
Yeah, just about.
Yeah.
Well,
Great.
you're in good company. 75% of those attending today said green, absolutely. 23% said yellow, and a couple said red.
I do see some questions about, can we get access to these prompts? The answer is absolutely. So we do have Stock Simplifier. All these prompts are included in Stock Simplifier. Every single one we're going to go. Stock Simplifier is $199, but we do have a deal for everyone that's watching this webinar and our replay. You can get it for $99. Stoffel, if you could put the link
The
to do
link
that
is
in the
going
chat.
in the chat right now.
There you go.
If you click there, you can get access to the tools and all the prompts.
All the prompts. So if you already have Stock Simplifier, you have access to everything we're doing. If you want to buy Stock Simplifier, you can get it for half off during this webinar. All right. Next section, moat. Moat section. Does the company have a moat? Now in Stock Simplifier, we have 3 sections. No, or it's weakening. Yes, but it's narrow. And green, awesome. It's wide and expanding. Now, when it comes to analyzing a moat, there's 3 things you have to analyze. 1, what is the moat source? Which moat source is the largest contributor to the moat? 2nd, what is the current state of the moat? Is there no moat? Is there a narrow moat? Or is there a wide moat? 3rd, equally of important, maybe even more important than any of the last 2, what is the direction of the moat? Is the moat shrinking? Is it stable? Or is it widening? So, Brian, let's do a poll. What do you guys think?
Real quick before we do the poll, we got a bunch of questions about the Stock Simplifier. So there's 2 things that I just want to make sure are super clear. 1, this is a one-time fee. It is not an annual charge.
Yes, good point.
One-time fee. It's $99. And also, you will have access to all of the updates that we create for this AI prompt. As you saw, we're on version 18. So if you pay the $99 for this, you will get versions 19, 20, 20, and I'm sure it will continually be updated. So Mark is someone who said they already bought it. Yes, you have access to those prompts. So I hate to take our mind off the moat real quick, but a bunch of people just had questions about that.
Yeah, so as AI moves super fast, we're going to do our best to stay on top of it. And as we learn, we will update the prompts. We will update like what we're teaching. That's why we do these live sessions, because we plan on doing these roughly once a month, if not every 2 weeks aspirationally. But as things happen in AI, or as we create new tools, we're going to share them here. That's the goal for doing these live. All right. So with that out of the way, let's do a poll, Brian. What do people think? What is Google's primary moat source?
Yeah, this is going to be interesting because there's a lot of different ways you could look at this.
Yep. So this is primary. If you think they have multiple moats, that's fine. Which do you think is the most powerful or the primary one currently? Okay. Well, there is a number 1 choice out there.
Yeah, there certainly is.
People seem very confident in the number 1 choice here.
All right, so I'll go ahead and share. Now this is interesting, Brian, because before we look at the AI answer, I'm just curious. Folks said network effects 65%, and then everything else just kind of got less than that. I look at it, and in my way of viewing moats is I think it's low cost production, and my idea is this: I'm trying to remember who's the customer. And remember, we found that in the previous prompts, advertisers are the customers. Now, does that mean that the ad network is better if you place an ad and I do? I'm not sure, maybe. But I think low cost production. Why? Because I think personally that Google can generate data through Gmail, through search, through Google Docs, through, countless, that, what do they have? 7 tools with over 1 billion users, 8 tools.
Something like that.
I think that it will do better because of low cost production. I do agree that like YouTube does have a network effect. That's there for sure. But that's how I view it. I'm curious how you view it, and then I'm curious what AI is going to say.
I would say, so the number one choice here, are you sharing, is network effect.
Yep.
Totally understand why people say that. Google became Google because of the network effect. They had the most searches out there that gave them what were people searching for. They served up the best traffic. 100% that does make sense. I would agree with Stoffel here. Their actual current moat is low cost production. They can reach the widest thing for the lowest internal cost given their immense scale. And that allows them to deliver ads to people at a lower budget, or reach target customers at a lower budget than anybody else. But I don't think network effects is a wrong answer. I don't think switching costs is a wrong answer. I don't think intangibles is a wrong answer. I think it has multiple moats, and which one you think is the most important depends on how you're viewing it. But okay, let's see what ChatGPT thinks. So here is the moat analysis. I'm going to copy that. Let's paste this here. Copy paste.
I'm curious.
Yeah.
It's funny that it's searching Google.
Oh, it is searching Google. Okay. All right. So what does ChatGPT say? Current moat, wide. Current moat direction, stable. Primary moat sources. So ChatGPT says switching costs and intangibles. Okay. Why? Alphabet maintains a durable moat found on a strong brand and network effects.
Oh, so it mentions
high
network
switching
effects.
costs amongst advertisers. That's a good point. Users and ecosystem partners. Its wide moat status is echoed in Morningstar's ratings. For example, operating margin expansion and strong growth helps to sustain these advantages. Now, we programmed this prompt to go moat source by moat source and tell you what it thinks in case there's multiple ones. So for switching costs, it says, yep, it's got one. It's currently wide, and this moat is stable. Here's some analysis. Here's some reasons as to why, right? They're all moving. They all have friction and moving away. And then it has some supporting metrics here, as well as a quote from the recent call. God, AI is so cool.
And I would say with the with Google Cloud, that makes total sense.
Yep.
And it calls out Google Cloud there as well.
Intangible assets, wide, and this is stable. So their brand name is globally recognized, very dominant in search. YouTube is become a verb. Lots of R&D spending. Quote from the recent call: "We're driving operating efficiencies, significantly lowered machine costs and latencies through breakthroughs." Although that would probably be a low cost thing. All right, network effects. This says they're present, but they're narrow, and they are also stable. Searches improve with more data, helps it to train. YouTube is a large base of users.
Yeah.
However, these network effects are somewhat mature and challenged by privacy regulation, competition, or new rivals, and they're less likely to widen dramatically in the years ahead.
And look at that, Brian. That's what you said. You said, look, it got its start with this, but I don't believe that's what provides it today. I agree with that.
Okay. Low cost production.
Oh man, come on. All right, so I'm not always going to agree with ChatGPT, but it did a pretty good job.
Yeah, Alphabet benefits from scale from infrastructure and AI. It's not meaningfully lower the low-cost producer in all segments. Its traffic acquisition costs can also attain efficiency. The cost it holds meaningful but insufficient to sustain a moat. Traffic acquisition costs are rising. R&D expenses are very high, and cost of revenue increased, primarily driven by higher acquisition costs and depreciation expense. All right. I don't necessarily agree with the analysis, but at least it's had a logical argument.
Now, Brian, just for this next one, we had someone ask, what is counter positioning?
Counter positioning is when you create a new business model that disrupts the way that something is done, and it forces the incumbents to change their business model and give up revenue in order to compete. So Google also had counter positioning. Who was Google's big competitors in the beginning? Newspapers,
Yep.
cable TV. For them to go online, they would have had to blow up their existing business model that they beat on. So in the beginning, Google had counterpositioning. I would argue that it already won because of counterpositioning, and that this is no longer a moat because there's Facebook out there as an advertising partner. There's TikTok. There are multiple companies that are now competing. So this is a great moat at the start, but this moat dies fast.
Yep. Now, Brian, just for keeping us honest, Mikhail went and put this into Perplexity, and there it said there was a low-cost production mode.
There you go. Well, it's going to depend on the AI that you do, but you can see that this prompt gives you original sources, and we also added Morningstar to it, so it should be able to search Morningstar. I have no idea if that's illegal or how that works, but it does it. It does it. So that's a ChatGPT problem. Very, very cool. Okay. I'm going to speed up a little bit here because we're going a little slow. I do want to keep this to under an hour. Okay. Next, long-term potential. Can the company grow meaningfully over time? Now, the easiest way to figure this out is to go to fiscal.ai, type in the company's ticker symbol, Google, and look right here. Earnings per share long-term growth rate. So Wall Street says Google's earnings per share are going to grow 15% per year over the long term. So over the next 5 years. So that's the number, right? That's the number. The point here is to say, why should we believe that number? What's the story that's going to create that growth so that we know on the inside that the company can grow? Well, there's two ways you can grow. One, get new customers. Two, get existing customers to spend more. And these are the methods that the companies can use to get new customers or to get existing customers to spend more. Brian, let's skip the poll on this one for a sec, just for the sake of time, but I'm going to copy this over and I'm going to paste this here. And Google is going to do that analysis on, ChatGPT is going to do the analysis. These prompts work in Perplexity, in Grok, in Claude. They work in Gemini. They should work everywhere. You won't get the same result everywhere, but we design these to be prompts so that they work with whatever LLM you like. Okay. Growth drivers for Alphabet. Balancing new growth. And we color-coded these. So new customer acquisition. This is a moderate area for the company. New distribution. This is a weak area for the company. Is adding radically new distribution. Okay.
Not really. Is not. Limited evidence of it.
Yeah. Geographic strength, geography, moderate. It's continuing to push into new markets. Acquisitions, it's not really an acquisition-focused company, even though it did acquire Wiz, right? That was like 30
the cybersecurity firm.
Okay, how about existing customers? Pricing power, yes. The company can continue to grow within its existing customer base through increasing prices. Can it launch new products? Yes, it's definitely doing that. Yep, with Gemini and more. And can it retain product and can it retain customers? Yes. Yes, it can. So why should you believe that Google can grow? Number one, new products and services. Number two, pricing power. Number three, geographic market expansion. Number four, sales and marketing. And then these are lesser examples. And then we have a nice visual summary down there. Isn't that nice?
Yeah, I love the visual summary. Like
quotes.
The big thing we tell you is this is such a great way to get started. It is not an end that we would never say, look at the colors and then make a decision to buy or sell, but it's such a great way to get started.
Yeah, it's a cool visual. Okay, so we can do the poll now. Do you think Google has growth potential? Red, no growth potential. Yellow, it's moderate. Green, it's great. Google has great growth potential.
We'll just let it go for 30 seconds and then I'll share our results here.
Yeah. After the first poll, we get lots of fast answers because everyone knows kind of what to do. All right, we already have 60%
Yeah.
participation. So what do people
So
say?
we said, well, 54%, it was basically 50-50 between yellow and green. Yellow eked out by just a little bit.
If you're a hyper-growth investor, Google probably doesn't interest you. If you're a stage 5 capital return investor, 15% compound annual growth is pretty darn strong, especially for a $3 trillion business. If you just joined us, by the way, and you want these prompts, Stock Simplifier is $99.
Yep.
There is a link. There is a link in the chat there.
It is in the chat. And also, just so you know, a couple people ask, a subscription to fiscal.ai is not included. You can use the website for free. It just doesn't have full functionality.
Nor is it required.
Nor is it required.
Yeah. So fiscal.ai premium subscription is not included, nor is it required. We both are paying subscribers to fiscal.ai because we think the data is great, but we built Stock Simplifier assuming you have to spend nothing else to research it. All right, next, key metrics, the key metrics. So this is, I think, the best thing we did with Stock Simplifier.
Yep.
The metrics that you look at to analyze a business need to change depending on which phase the company is in. That's why we did phase analysis first. The metrics change. For stage 5 companies, here are the 5 key metrics that we suggest looking at. So 3-year revenue growth, free cash flow conversion, EBIT to interest, return on invested capital, and whether they have a capital return programs. And then we have red, yellow, and green guidance in there. So that is, we in Stock Simplifier, we teach you how to do all this, and you can absolutely use fiscal.ai to look all this up. But we're gonna use cheats, right? So let's go to the key metrics. And I know that numbers is a thing that I've seen AIs struggle with, like they've really struggled with. So what company? So we're gonna do Google. I'm also gonna type in phase 5.
Yeah, you got to put in both. That's key.
Google phase 5. Okay. So here we got, what do we got here? Okay, so revenue on a 3-year basis has grown 11%. And this says yellow. So that should actually be green. That should be green.
But
so
that's okay. We just saw a little kink that we've got to iron out, and you'll get the corrected version.
Yeah, but it's stable and upward bias. Okay, free cash flow to net income. This says red. Data is not enough to compute precise ratio. Well, that's not accurate.
That's not accurate. We did it before, and it said 58%. But again, there you go.
Yeah, that's exact same prompt. Sometimes different answers. That's why we had to play with this so much. So unfortunately, that's not going to be helpful there. EBIT to interest expense. This says yellow. It says 5+. That should also be green. God, this is horrible. These results are terrible. I'm gonna actually rerun that.
Yeah, do it. See what happens. Because I'm curious too. We did all of these just before we got started.
Yeah,
it seems like it wasn't going to. Oh,
look at that! Different results.
Hey, you know what? We're learning in real time exactly how important this is. Although I will say, that second one is wrong too.
Yes,
because that should be yellow.
This is more accurate,
but still not completely accurate.
Same prompt, same exact prompt. God, the prompts are so detailed. Anyway, that's a frustration.
That's okay. I think it's important to practice using this out loud with people so that we all know this is super helpful and it's not gospel.
Correct. So anyway, I would agree with this. This is definitely above the 10% target. That's great. Free cash flow conversion was roughly 65-ish%. That is, this should be yellow.
Yep.
Right? This should be yellow. It's a decline from ideal, but strong. EBIT to interest is very high. This is correct. Yep. This is definitely correct. Return on invested capital. This is green because this number is high and it's over 20%. That's correct. Capital returns, shares outstanding declining, and dividend buybacks initiated for multiple years.
Yeah, but not 5+.
Well, the dividend hasn't been 5+. I think buybacks have.
Yeah, I guess buybacks have. That's true.
There you go. So strengths, strong return on invested capital. Capital returns are strong. Concerns, free cash flow to net income is under the target. Revenue growth is just over 10%.
Yep.
Critical things to watch. This is absolutely spot on.
Now, and of course, this is where you layer in what else you know. The whole reason for that, Brian, is because they're spending like that was the theme of the last earnings season, hundreds of billions of dollars on AI.
Yep, for sure. So I would say this running it the second time was definitely a good thing to do. Of course, if you want accurate information on this, that's why we use fiscal.ai. This information is 100% accurate. Yeah, sometimes you just have to use it. But anyway, okay, let's keep going for the sake of time here.
Yep.
Section 6, risks.
Oh boy.
Risks. Now, in Stock Simplifier, we have all risks boiled down to one risk. That risk is execution risk. What are the odds that the company can't do what it says it's going to do? That's really the only risk you have to think about. Now, there are many subcomponents that go into execution risk. We've highlighted 4: concentration risk, disruption risk, outside forces risk, and competition risk. And we have red, yellow, and green ratings on there. So let's go ahead and do some risk analysis. So here's our risk analysis prompt. Copy it.
Do you want to launch the poll first?
We'll skip the poll.
All right, we'll skip the poll.
Sake of time. Okay. So it's using the 10K and the most recent 10Q. Overall summary. This is a medium risk stock. Why is it? Disruption from AI search shifts.
Makes sense.
That's spot on.
Yep.
Regulatory and outside forces exposure. Also spot on.
Makes sense.
It's got a diversified business model, strong free cash flow, and AI compliance. Okay. Concentration risk. Green. None. No concentration risk. Great.
Totally buy it.
Disruption risk. Yellow. And it's
totally
increasing a problem. Great job, AI here.
I don't own Google because of that right there.
There you go. So I would say that this disruption risk is spot on. Outside forces risk, regulatory exposure, Department of Justice antitrust trial,
Just
EU
one
compliance. Yep. High CapEx environment, currency risk, definitely. I don't know if I'd label that red.
Yeah.
I would personally do yellow. And did they just win a big ruling?
They did. They didn't have to get rid of Chrome.
Chrome, yep. Competition, yellow. The trend is increasing. I would say TikTok. Amazon. Amazon is now in the ad business for sure.
And it's booming.
That's a new thing. So a nice little visual color coding here. All right, so now we can do the poll. What do you guys think? What is Google's execution risk? Low, medium, or high? Red, bad, high risk. Green, very low. Yellow, medium.
Yep. I would say our audience is very much in line with, we're already over half, so I'm just going to share the results. Over 80% said yellow, which is exactly where it would have landed for me as well.
Yep, I would say that is perfectly fair. Very cool. And if you've just joined us, I've seen the numbers going up and down. If you want access to all these prompts and tools, it's $99.
Yep, and the link is in the chat
and the
right
link
now.
is in the chat for that. Okay, final analysis, valuation analysis. Now, we built a prompt just for valuation analysis. However, I know that from the first prompt that we did, the business growth cycle prompt, it included in there, do this valuation work and avoid these valuation tools and the valuation. And the valuation ones that it said were price to earnings,
trailing,
price to free cash flow, trailing, price to earnings, and price to free cash flow. We can do that because it's in stage 5. Stage 5 allows us to do that. So it would, in Stock Simplifier, it shows up there. So this is stage 5, capital return, price to earnings, and price to free cash flow. So we're going to use, this is when we can't use AI.
Yep.
Or AI is not nearly as helpful. This is when fiscal.ai becomes helpful. You'll see why if you've never done this. So I'm in fiscal.ai. I click on financials. Okay. and then I'm going to click on ratios, and then I'm going to click on trailing valuation, and I'm going to pull up PE ratio. PE ratio. ChatGPT can't do this yet.
Nope, it's
It
not there
cannot
yet.
give us a visual like this. I have a feeling that's way too small.
But if I'm right, 27 times. So I think that's about what the S&P 500 trades for roughly right now.
27 times trailing earnings. And one thing we can do is we can put a median, an average, a low, and a high. So this is 10 years worth of data. So on average, this trades at 27. What's that? 28 average. That middle line is the weighted average PE ratio over the last 10 years. You can see that when the narrative was way against this company, it was down to 16 times earnings. In the wake of the 2022 crash, it was 17 times earnings. Currently about 27 times earnings. Now that's earnings. Let's do the same thing for free cash flow. Free cash flow. Price to free cash flow. Scroll up. There's a wild chart. It kind of goes up and down like crazy, but let's do that same analysis. So over the last 10 years, Google has traded at a median of 51 times free cash flow. It was as low as 27 times free cash flow. Currently 62 times free cash flow. So with those numbers in mind, Brian, let's do the valuation poll. What do you guys think? Google cheap, fairly valued, or expensive right now?
Oops, sorry, I didn't launch it for some reason. Oh, I got to stop sharing our previous one. There we go. Now it's up.
Okay, what do you guys think? Google cheap, fairly valued, or expensive?
This one's interesting. It's a little bit more diverse than I think I was expecting.
Yep.
All right, we got 60%. So I'm going to go ahead and share that about 70% of the people said yellow, fairly valued. 23% said red, it's overpriced.
Wow. What would you say?
I would say fairly valued. Yeah, that's probably where I would go with it.
I would also agree. I would say fairly valued. I've owned Google through all of this craziness, and I was not despondent in April. I should have been adding to my position, but I did not. I would say it's fairly valued today. That's what I would say today. All right, final poll. Now that we've done all of that analysis, what do you think? Are you interested in Google stock? Red is no. Yellow is yeah, maybe, or
Hold.
watch list. Green is yes, I'm very interested in this stock, and I would be an active buyer today.
Very interesting results. Again, I'm going to wait. Got about 2/3 of people. And Brian, it's really coming down to one of two answers. Our winner was officially green, 46%, but just a hair less said yellow. And a couple people said red. So I'd say a yellowish green in the end.
Cool. All right, let's start knocking out some questions, shall we?
Yeah, you bet. Let's see. Question number one. Let's see. We talked about the counter positioning. Ramaswamy says, Brian, my take is operating profits look compressed due to higher R&D, and eventually operating leverage will kick in. I'm guessing that's his way of saying, I think it might actually be stage 4. I think that's totally fair.
Yep. I don't think there's anything wrong with doing stage 4 analysis if you believe the company could be at an inflection point with AI. The stages we give you are squishy. Right?
Yep.
They're a little squishy.
That's a good way of putting it.
We still think the mental model of which stage it's in is unbelievably important. Very, very important. But if you have more advanced information that says, despite what the model says, I think it's in this, fantastic.
Someone asked, why does the analysis tab refer to operating profits rather than gross profits?
Yep. So gross profit is the profit that comes after selling the product or service. Operating profit comes after expensing overhead costs. So marketing expense, research and development expense, etc. The reason we use operating profit is that we think it's the cleanest number for the most businesses out there. If you do analysis on software companies, for example, software companies produce free cash flow years before they produce net income. Years before. And we would say that those software companies, even though they're unprofitable, are actually profitable.
Yes.
Other companies, it's the exact opposite situation where they produce earnings far after they produce free cash flow. So when we said for solving for simplicity, solving for the most useful, we decided that operating profit was the most reliable number for figuring this out. And it also neutralizes debt on the balance sheet that could cause very high interest expenses. It also neutralizes big one-time expenses that come below operating profit. No metric is perfect. This is the best one for most companies most of the time.
A whole bunch of people ask, can you use this on other platforms other than ChatGPT?
Sure can.
Cool.
We've tested it on all of the 5 major ones, and you get different results and different reliability. Like, for example, we have it programmed in there. Ask what company you want this to do analysis on. I banged my head with like perplexity. I was like, why is it not asking me what company? And we changed the language a bazillion times. So it's quite reliable on Gemini, ChatGPT, and Grok. It's less reliable on Perplexity. Claude has pretty fairly results, but we wanted these prompts to be universal, so they worked with whatever LLM you're using.
I love this. Anonymous says, this all comes down to AI, doesn't it? Do you think they can monetize search with new AI technology? Is this an anti-fragile company? I mean, if nothing else, I think that whoever that is asking the right question. Because to me, based on this very quick analysis, that is the same conclusion I come to.
I see some questions in here about why not use reverse DCF on valuation. You totally can.
Yep.
In fact, in the business model, the very first prompt we did, it said reverse DCF analysis, thumbs up. For Stock Simplifier, and specifically, we chose multiple analysis because it's Stock Simplifier, and multiples are simpler than reverse DCF. But absolutely, this could be a great stock to do a reverse DCF on, with the caveat: free cash flow right now could be artificially depressed.
Yeah, so that gets to a good one. Cass says, what do you do about the disparity between the PE saying it's fairly valued and the price to free cash flow saying it's richly valued? I would say you got to understand why that is. And it's because of those investments in NVIDIA chips, in data centers, in servers, and in energy. So if you believe that's worth it, then you could look more at the PE than the price to free cash flow. If you don't, then you might look more towards the price to free cash flow. I'd also throw out there, this isn't a part of Stock Simplifier, but again, going a layer deeper, you look at price to operating cash flow and see what you think.
Yep. Yas asks, is this available for European companies? Absolutely. Same exact analysis. If you want to use the spreadsheet, you do have to, the tickers are often a little bit trickier to put in. Like, you got to put like the native ticker. If you're using the ChatGPT prompts, you need to make sure you're like this ticker on this exchange. So if there's like a dot after it for that. So the answer is yes, it works for international in Stock Simplifier. I have a whole section in there about, let's see, right here, international stocks. How the instructions for how to use these with Google Finance, and like what you have to put before, depending on which exchange you are looking at, and examples and stuff. So the answer is
super
yes.
Helpful.
Yes, it does work on international stocks.
Super helpful.
Yeah.
I don't know. How many more do you want me to take here?
Let's do 1 or 2 more.
Okay. Let's see. Sorry. There's one in here that asked about regarding EBITDA and value investing. Charlie Munger famously called EBITDA BS earnings to criticize the modern account. What's your take on this?
I literally made a whole YouTube video about this concept. It's one of our most popular YouTube videos of all time. So if you want more details about our thoughts on EBITDA, you can certainly look at that. My overall view is I think EBITDA, not excluding the D, is a better metric than EBITDA but it's like anything. It's a number. It can be helpful as long as you understand the limitations. Too many people that use it don't understand the limitations.
Last one. Mario has a good question. I'm not sure what the answer is. Do you have to pay for the premium chat GPT to use Stock Simplifier?
So you shouldn't. No, I am a premium user. It might slow you down on the prompts. The prompt results should be the same. I think if you're a paying user, I've been a premium user for like 2 or 3 years. So
Right,
forgive
same
me, I
here.
didn't test it on that. You should be able to keep doing prompt on prompt. I think if it gets busy, it slows you down or it does it later. But again,
Try on Gemini too.
everything we built in Stock Simplifier is designed so you don't have to buy anything else.
Right.
So the answer is yes, it should go in there. Cool. All right, so that is how we research a stock using Stock Simplifier. That's the exact process that we have used for years. We probably should have done this at the beginning, just so people know who the heck we are. Here is my personal portfolio returns up until February of 2025. I just haven't updated the chart. I have outperformed the S&P 500, total stock market, and the NASDAQ. The NASDAQ is just under there using the research method that we just showed to you. It wasn't called Stock Simplifier, but the exact same analysis.
Yep. And I saw a whole bunch of questions about me owning or not owning the company. My start period is a little bit different than Brian's, but you can see my returns in the green there. The S&P 500 is all the way down there in the red, and the NASDAQ composite, believe it or not, is actually in the yellow. So outperforming the NASDAQ by almost 200 percentage points.
Yeah, pretty impressive. So Stock Simplifier, we think, is a phenomenal teaching tool, product, AI research for people that want to do it yourself. If you're like us and you're an investor and you just want to do it yourself, it's the tool we wish we had when we first started.
Yep. But we also understand that that might be asking a lot. And so if you want to be able to do all of these things that we're talking about, but you want me to do it for you, we also have a plan for that. And that is called Stock Investing Mentor. And Brian, there's 3 big parts of Stock Investing Mentor.
Yep. So Stock Investing Mentor is first and foremost, it's a training program where once a week you meet with Brian Stoffel to do a live 1-hour training session.
Yep. Second, you get full access to my portfolio. That means anytime I make any moves in my portfolio, you will know about it.
And then third, with Stock Investing Mentor, you get a private online investing community. So these are the 3 primary components that you get with Stock Investing Mentor.
Now we just want to dive into each one. So first, those 1-hour training sessions. I've developed a framework called the ADAPT framework, and it basically repeats every 5 weeks, but we cover a new topic each time. We meet on Thursdays, we meet at noon Eastern, everything is recorded, everything is available to consume whenever you want, and each one of these can cover a lot of different topics, Brian.
Yep. So every week we rotate through the ADAPT framework, Stoffel's adapting framework, and we cover a different unique topic. So Brian Stoffel goes deep on, 1 week is on moat. The next week is on how to read a balance sheet. The next week is on how to use multiple analysis. The next week is on when to sell, etc. So this cycle repeats every 5 weeks, but every week there's a brand new topic to dive deep on.
All right. Second, you get full access to my portfolio in real time. What does that mean? It means that anytime I buy, sell, trim, or add, you will know about it. You will get a video explaining why. And at the end of every week, no matter what's happened, you get my updated just portfolio. Because of course, if I don't make moves, stocks still move. So percentages can change, and my returns.
So if you want to do it yourself, Stock Simplifier can help you do it yourself. If you want to let Stoffel do all the work for you and you can just follow his portfolio plus the explanation with why he's doing it, that's exactly what he does in Stock Investing Mentor.
That's right. And third, we've got our private online community, which I will say is usually the least appealing to people when they join and the most appealing when they renew.
So we have the ability to connect with other investors that are just like you. You can ask questions. Importantly, because this is a premium community, you don't have to deal with any of the trolls or any of the nonsense that you see on like Twitter or on Discord or on Slack. We are big believers that free communities have very little value because anybody can come in, but premium private communities have a ton of value because everybody that's in there is on your side and is an investor just like you are.
Yep. So who runs Stock Investing Mentor? I take the lead on this. Mr. Feroldi helps out. The other Brian Withers, and our friend Ken Taylor all help run this service.
So those are the three things you get: the weekly live trainings, direct access to Stoffels portfolio and real-time trades, and the investing community. But we do have a couple of extras we want to let you know about.
That's right. Number one, you get access to my watch list. So about every 8 weeks, I update all my valuations and I include all the stocks that I'm watching. And so you have access to that.
Second, you get access to a free course called How to Find Unlimited Stock Ideas for Free. So in this course, we teach you how to find stock ideas for free.
And number three, you get access to all of the calculators. I see Samuel asked a question about this. All of the calculators that I've been using for valuation, you get access to as well.
Yep. So this is everything that you get if you do choose to sign up for Stock Investing Mentor. You get the weekly live training, the portfolio access, the community, and those three bonuses we just mentioned.
It's important to note, if you decide to try out Stock Investing Mentor and you're not happy, we have a 30-day risk-free guarantee. If it's not for you, that's totally fine. Just let us know and we will issue a refund immediately.
So remember, before we show you the price, one good stock idea or one piece of education or one connection with a fellow investor can totally pay for the cost of Stock Investing Mentor many times over.
Yep. So what is the price? Well, to the public, it is $9.99 per year, $3.99 on a quarterly basis. However, because you are here, you've made it to the end of this webinar, you can become a member for 20% off. That is $7.99. I will be putting the link to that in the chat right now.
So we currently have over 500 members in Stock Investing Mentor. We've interviewed some of them, what they thought. Amit here, he said, if you really want to be an intelligent investor, you should join Stock Investing Mentor.
Yep. Or Paul, who said that it paid for itself many times over.
Or Francesco, who said it was the best investment I made last year when he joined. Now, we do have some questions, common questions that we get about Stock Investing Mentor. So Stoffel, what if you work full-time? How are you going to fit this into your schedule?
We actually designed this for the busy working professional because, yes, of course, making it live on Thursday at noon Eastern is great, but I would say only about a quarter or less of the people do that. The rest consume it on their own time because you get access to everything we're going to go over in the following week 5 days beforehand. So you can look at it on your own time. You can watch the replay. You can ask questions. So you should be able to consume it whenever it makes sense for you.
Question number 2, what if you're a beginner investor?
2 things. One, first of all, I know what that's like. I was not in finance at all. I was a middle school writing teacher. And so we've designed it so that beginners can come in and do well. We've got a library full of our previous lessons, and we actually just launched an AI librarian that is designed to help people get up to speed.
Number 3, what if you can't make the live sessions? What if the times just don't work for you?
Well, as I said, we publish everything we're going to be going over on Saturday, but we don't actually have that live session until the following Thursday. So you can consume it, you can ask questions, we can answer them live, or if you do it some other point in time, we respond every day. We're on there responding to comments and questions that people have.
Brian, one more for you, since we have a lot of people here from international markets. Is this only for U.S. investors?
No, it is definitely, it is focused. We use my portfolio as an exemplar. So you're going to see a lot of US stocks, but the dynamics are exactly the same no matter where you are in the world.
So if you guys do want to join us, we will have that 20% off coupon. There is a link in the chat. We will give you a little bit of time to think about it, though. The offer that we're going to give you does expire this Friday at midnight. So we will, this offer that we're giving you, the 20% off, it does expire as of midnight on this Friday, September 19th. With that, do we have any questions, Brian, in the chat about Stock Investing Mentor?
Nope, I don't think so. We had just a couple other people asking about different LLMs, but no.
Very, very cool. Very, very cool.
All right, yes.
Raya just asked, is there going to be an email recording later today? Yes. Everything we just did has been recorded. Thanks to Stowe for reminding me to hit the record button. I will be, it takes a couple of hours to like upload it and get that going. But everybody that attended, everyone that's still on the call is going to get a copy of this whole presentation, as well as one of our prompts, the prompt that we use at the beginning to analyze the business and the business quality. We are going to be including a link to that for free, since you made it all the way to the end here and you've stayed with us at this time. So I will email everybody that at the end, as soon as this session ends here.
All right. Well, Brian, hey, not bad. An hour and 6 minutes.
Ramiro says, how many trades do you do in a year usually?
Myself. It's been changing, but so every 6 weeks I reevaluate based on valuation, and there's some others. So in a full year, maybe 30. I'm going off the top of my head there, though.
Is it fair to say that changes depending on market conditions?
Yes, that is very fair to say. And what you see during earnings season.
Here you go. So if you're still here, mark your calendars. 2 weeks from today, Tuesday, September 30th at noon, same time, same place is going to be our next session. The Wednesday before that, we will put in the newsletter 4 stocks for you to choose from. We're not going to do Google since we just did Google. But if you have stocks you want us to do, email us, respond to the newsletter, put them in the chat here. I saw Roblox was a stock that people wanted us to do.
CoreWeave, Rocket Lab, yep. Broadcom. I wrote them down.
Yep. Okay, great. So we're happy to put a couple in there, and we look forward to doing this hopefully every 2 weeks or so you can stay up to date on the latest in AI as well as the latest with stocks happening. So thank you guys so much for paying attention to us. Brian, let's go old school on this, shall we?
Let's do it.
Out.